Everyone, welcome to another episode of Adam Live. Every Wednesday, 12 Eastern Standard Time. Appreciate everyone checking in. This is update number one on the Ways and Means tax bill. And I will give you my thoughts, kind of tell you where I think things are going. It's been over 4 weeks since the tax bill was basically announced on September 15th. So I'm going to do a quick recap of some of the key provisions, not just retirement account provisions, but some of the key tax provisions. And keep the questions coming. I will do my best to answer all of them. And we're going to have some fun here. So kind of a relaxed 30, 40 minutes where we can spend some time together. I can kind of give you some thoughts on current events, current matters impacting retirement accounts, taxation, investments, and we can communicate and at least have some time to do some Q&As, which is going to be fun. So let's get started. Here's kind of what's going on. So as of today, actually, there's been a little bit of development. President Biden said that he's willing to forego 2 years of tuition-free community college. That's likely not going to be in the bill. He acknowledged the opposition from Senator Manchin. Also, a clean electricity program would require Democrats to abandon it. So that's two programs that may not make it into the final bill. Also, there's been some chatter that he's trying to push progressives to accept a price tag closer to $2 trillion instead of the $3.5 trillion proposed bill. So there is definitely some wiggle room there. I think most people expect the final bill to be around 1.5 to 2.5 trillion. So what does that mean for various tax and retirement provisions? Well, we'll see. Too soon to know. I think we'll probably know more in the coming weeks. From what I've been told, nothing will be finalized for at least 4 to 6 weeks, but who knows, right? Recent Wall Street Journal article actually said it could be weeks, even next week, potentially, where we can have some agreement on a final infrastructure / reconciliation bill. Speaker Pelosi mentioned she's hopeful towards the end of the month, which is about 10 days or so away. So there is definitely still time. We're probably in like the 5th inning of a 9-inning game. I don't think we're in the 7th or 8th inning. I think there's still a lot of negotiations going on. Even in the retirement topics, I think people are starting to wake up a little bit and see what is going on. There's been some op-eds, former senators in USA Today, other publications. There's some other groups that have been pretty active and, hands off my IRA. And finally, I think people are understanding that the impact of some of these retirement provisions, especially prohibiting IRAs from investing in accredited investor investments, are actually pose a major detriment to not just investors and investor diversification options, but also to American businesses. So I'm confident those provisions will at least be watered down, if not completely removed from the bill. So that's my hope. But let's just do a quick recap. It's been almost 5 weeks since the bill was proposed back on the 15th, and it's part of the Build Back Better reconciliation legislation. The House and Ways and Means Committee voted 24 to 19. The only Democrat that opposed it was Stephanie Murphy out of Florida. And I've actually reached out. I have an office in our district, so I've had the pleasure of chatting with some of her colleagues, and I think she understands some of the negative impacts these provisions could have on the American economy. So I'm going to go through some of the key provisions. Obviously, this is a $3.5 trillion bill. The idea is that all these social programs, infrastructure, child tax credit, and the such will be paid likely and foreseeably by tax increases on the rich. So the first big proposal was the increase in corporate tax rate from 21 to 25%, or I should say 21 to 26.5%, excuse me. And essentially the rate would provide 18% on the first 400,000, 21% on income up to 5 million, and then 26.5 on income thereafter. Not a drastic increase. This was actually more moderate than many people expected. Some people expected it to be 28, 30%. So there is some type of graduated system. So this proposal isn't horrible. And I think there's a strong chance this makes it in the bill, clearly. The top individual tax rate will go up to 39.6 from 37. And this will actually apply to individuals making over 450, married, filed jointly, 400 for single. So this is a pretty big jump because now the highest tax bracket generally kicks in around 650. So this would bring it down to 450. And this is just kind of the theme and trend of the bill is for some reason the Biden administration has a number of 400 or 450 as the rich number. So if you make more than 450 and you're married, filed jointly, in their eyes, you're rich. And trust me, I know lots of people, well, not lots, I know plenty of people that make over 450 and they are still paying off their student debt. 450 in New York City or San Francisco is not 450 in New Hampshire. It's just the way it is. And if you have a two-income family, the wife's maybe a banker, the dad's a lawyer, you're going to hit that 450. And doesn't mean you're rich. In fact, you still may need student aid to get your kids in private school because it goes fast, right? With taxes, state and local taxes, federal taxes, mortgage payments, school expenses. You're not having much money left, even if you're making the 450. So that's one of my issues in the bill. I just think they're trying to attack the super rich, but they're going after really the moderate rich. And I think that's a problem. But again, I think this provision passes. The capital gains tax rate will go from 20 to 25%. This is actually moderate because before the bill was passed, there was a very strong opinion by many that there would be a 40% tax on income over $1 million, a 40% capital gains tax on income over $1 million, and that never made it into the bill. So the 25% increase is actually pretty moderate. There's a net investment tax that will be expanded to cover income derived in ordinary course of businesses, which is not the case now. And this would be if you make more than 400, if you're single, 500, married, filed joint. So this is kind of a bit of an expansion of the Section 1411 net investment tax. The qualified business income deduction will also now be available to businesses, pass-through entities. The 20% deduction was pretty much a hallmark of the Trump Tax Act in 2017, and this tax bill seeks to limit its use by high-income earners. So we'll see. That I think will also pass. There's also going to be a 3% surcharge on income over $5 million, $2.5 million if you're single. This is arguably instead of the elimination of the step up in basis. Again, I think this will pass. Not a horrible type of provision. I think this was what people would accept if more of the increase in taxes were for people making 2.5 to 5 million. I think more people would accept it versus attacking people that make 450,000, which again is not uber rich. You're successful, doesn't mean you're not successful, but doesn't mean you're uber rich if you make 450,000 bucks a year, two income home. 5 million, yeah. If you make more than 5 million and you have to pay an extra 3% tax, hard to argue against that. So I think that stays. Also, there's the lifetime exemption or unified credit, which is now 11.7 million, which will expectedly drop to 6.03 million. This will pass as well. And again, if you have assets over 11.7 now, or you expect to have assets over 6.03 next year, this is your last couple weeks to do some estate planning, because once this bill passes, the grantor trust rules, which this bill seeks to eliminate its potential usage, will no longer be a estate planning option. So if you have a estate that you think will be, or I should say, if you have assets worth more than 11.7 now, 23.4 married, filed jointly, or will have more than 6.03 next year, you have a few weeks. You should call contact a trust and estates lawyer, you have some time to do some tax planning, potentially through GRATs or SLATs, irrevocable trust, to protect some of those assets. As I mentioned, the end of the grantor trust, this bill, there's several provisions in it that seek to limit its ability to have taxpayers contribute appreciated assets to a irrevocable grantor trust and have it removed from the estate of that individual. Those provisions will end the reign of the grantor trust, which has been a increasingly popular estate planning technique for the last 20 or so years. So that's a big provision. And again, I have been told that by many trust and estate lawyers that they are confident this, unfortunately, will stay in the bill. Okay, let's go to the retirement accounts, and I'll briefly describe some of the retirement-related provisions, and then I'll get to some Q&As and talk to you kind of what my thoughts are and do to keep fighting the good fight. So the 10 million cap. Initially, before the bill was passed, we thought our industry knew a cap was coming. We actually thought it was just going to be for Roth IRAs and would be limited to just $5 million. So when we saw $10 million cap, we were pleasantly surprised. We were not happy, clearly, with a cap. I've said this many times on videos and various podcasts that I am strongly against capping people's income, especially in the retirement world. It kind of goes against the entire system. We're not capping people's wealth. We tax wealth. We don't cap it. No other country that I'm aware of, democratic first world country, caps people's retirement accounts. Not even Canada or some of the more socialistic type countries. So this is I think a drastic policy move. This is something that Senator Wyden of Oregon's been pushing for pretty much for the last 10 years. He proposed a $5 million cap in 2016, which didn't go anywhere. And now he's able to get his wishes and his dreams answered, so to speak, because the Democrats are in total control of the House, Senate, and presidency. Although their control is limited in the Senate, essentially a tiebreaker by the vice president. They only have a couple seats in the House, so negotiations will still be needed. Although this is something that we believe will pass. Why? Because in today's day and age, with the ProPublica articles on Peter Thiel, it's hard to defend rich people, right? Tax the rich. We all saw what AOC did and some other politicians. It's not super popular to defend rich people. Now, the one caveat to this provision is that if you're able to keep your income under $450,000 or $400,000 if you're single, there's no cap. So why did Biden put it in there? Or I should say the Ways and Means, Neil, who chairs the Ways and Means. This is another way of saying, hey, we're not just targeting every person. It's only the rich. So if you make more than the 450, there's going to be a cap. If you make less than the 450, we're not going to increase any tax income for you, right? That's been their whole slogan, that if you make under 450, you're not going to have to pay an extra dollar of tax based off this bill. So that's why they threw it in there. But they knew, and they know, that most people that have $10 million in retirement account plus are going to have income just from their investments of probably over 450, especially if they're married. So they threw it in there just to appease and keep the argument and keep their position and their ability to keep marketing their bill that this will only hurt the rich, even though 450 is an arbitrary number for who's rich or not, right? And it's an annual test. You can make $500,000 this year because you've sold some assets, and then your income can go down to $100,000 next year. Tough luck. If you have more than 10 million in your IRA, you got to take distributions in that year because you exceeded the 450 income. So the way it works is if you are above the 10 million, and again, there's not a lot of people, just some statistics. There's only 497 people that have more than 25 million in a retirement account. That includes Roths, traditionals, and 401ks. There are approximately 28,000 taxpayers that have more than 5 million in a retirement account. And again, time value of money. Based off the principles of compounding returns, your money doubles every 8 years. So Wyden and his team have said, look how many more retirement accounts are going up in value. There must be something wrong here. Those people must be cheating the system, because how could so many more people have more than $5 million in their IRA over the last 6 or 7 years? But they're forgetting the whole point of the retirement system is taking advantage of the power of deferral, the power of compounding returns. And what the formula says is as follows. If you average 8% rate of return, every 8 years, your money doubles. So if you had $2.5 million 8 years ago, and you generated an 8% rate of return, which has been totally possible over the last 8 years with a very strong Wall Street bull market, strong real estate marketplace, you're going to have 5 million plus in your IRA. Doesn't mean you've cheated. Doesn't mean you're a sinister, evil person. Just means you've followed the principles of compounded returns, and now you have more money. So Wyden took this fact and said, look at all the people that have now have more than 5 million. The number was way smaller 6, 7, 8 years ago. No kidding. In 8 years, there are going to be more people with 5 million. It's just the time value of money. That's the whole point of the retirement system. That's why people want to invest in the retirement system, because it works. So it's kind of inaccurate and definitely, I think, kind of insincere to just say that there's so many more rich people in retirement accounts, so there must be some sinister plot and there must be some high level of cheating, because how could all these people have so much more in their IRAs over the last 8 years? Well, it's not so hard to figure it out. So basically, if you have more than 10 million bucks, you got to take distributions to get it to $10 million. And this is the issue. If you have a Roth IRA and you're under 59 and a half, even though a Roth IRA is after tax and they're forcing you to take a taxable distribution, even though the Roth is after tax, they're going to make you pay tax on the amount you have to take out over $10 million if you're under 59 and a half. No 10% penalty. Wow, thank you so much, IRS. But tax. So that's unfair, right? Because you are forcing these people who have played by the rules. They have a Roth IRA. They've been told since 1997, when Roth IRAs were created, that, hey, if you make contributions to a Roth or you convert to a Roth, you pay the tax on the conversion, and you save in a Roth IRA, once you are over 59 and a half and the Roth's been open 5 years, you can pull everything out tax-free. But prior to that, no one is forcing you to take money out. There is no mark-to-market, required distribution. There is no requirement to take a distribution. So what are they doing now? They're saying, sorry, game's changed. We're changing the rules on you. Now you have to take a taxable distribution. But Biden and his team are smart. Remember, they said, if you make less than 450, no one will pay more in taxes. So that's why they threw that 450 number in there. They say, listen, if your income's less than 450, don't worry if your IRA is over 10 million. We're not going to make you take a taxable distribution. Why? So they can keep their marketing angle and their marketing slogan going that says this is only for the rich, even though, again, making over 450 doesn't make you rich. It makes you successful, not rich. So this is all a game to show that they're attacking the rich. So that's why they threw the 450 number in there. So they can say, oh, you don't have to pay any tax if you make under the 450, even if your IRA is over 10 million. But again, it's probably unconstitutional. I'm sure you're going to have some taxpayers bring a constitutionality claim if they're forced to take a taxable distribution on their Roth IRA under the age of 59 and a half because of this provision. Now, why are they doing that? Simple. Peter Thiel. Peter Thiel is under 59 and a half. He's got billions of dollars in an IRA, in a Roth IRA. So if they said, sorry, you have to take the distribution out of the Roth, but it's not taxable, they're not going to be able to go after Thiel. But now, the way this provision is structured is they can say, yeah, we're going to make you take a taxable distribution on the Roth, even though you're under 59 and a half, even though you're not required to. We're going to force you to. We're not going to make you take a 10% penalty, don't worry. But you're going to have to pay tax because they're going to get $4 billion of tax, not on tax revenue. So if he pays 39.6% on $4 billion over 2 years, it's a lot of money. So this is really to attack Peter Thiel. There's not many taxpayers in the Peter Thiel category. According to our industry, there's, again, 0.2% of our clients have more than $1 million in their IRA. This is not a problem, but Wyden is making it a public problem. So people think that there's all these rich people out there that are cheating the system, and it's just not true. The numbers don't bear that out. And on top of that, they're forcing these people to take taxable distributions, even though they've followed the Roth IRA rules, and based off the Roth IRA rules as they are currently constructed today, they would not be required to do so. So it's certainly unfair. I have sympathy for these people because they've done everything wrong. I have a number of clients that have Roth IRAs over 10 million. Again, I have a number of clients, but I also have over 30,000 clients. So I probably have less than 5 clients that have over $10 million in a retirement account. So again, those are just the percentages that I think Wyden is not understanding, even though the numbers are pretty clear. And he's going to force these people to take a taxable distribution, even though they've done everything wrong. I spoke to a client a few days ago who has over 10 million. He's like, Adam, I've made all my money in stocks. Like, this thing is crazy. The last couple of years I've diversified and done some real estate, but the bulk of my 10 million plus is made in stocks. Like, what are they doing? I don't understand this. And, you know, I'm in my 50s. I've done well. I've saved. I've hit some deals, but these are all publicly traded stocks. Like, I'm not doing anything that's not available to any American. So it's super unfair. I feel for him. But I do think this is going to stay in, just because I don't think there's a lot of sympathy for rich people these days. The revenue raised is just $1.7 billion over 10 years. Not a lot of money when you're talking about a $3.5 trillion bill. Even if it's pared down to $2 trillion, $1.7 billion over 10 years is not a significant amount of money. You're talking about no more than a few thousand people. Not sure if it's constitutional. We'll see. And of course, it seems very unfair. They also want to get rid of the backdoor Roth IRA. So since 2010, if you make more than $208,000 in 2021, you're not able to do a Roth IRA, but you're able to do now what's called a backdoor Roth, which allows you to make after-tax IRA contributions and then convert it to Roth. That will no longer be available. They are basically going to eliminate the backdoor Roth. Again, not a revenue raise, right? It's not helping anyone. Trust me, Jeff Bezos, Warren Buffett, they don't care about backdoor Roth IRAs of $6,000 or $7,000. The fact that they're trying to close this solution is just makes no sense, because this is just helping the average person just add a little bit of money. I mean, you're talking $6,000 or $7,000 a year, not $100,000 a year. So not sure why they're doing it. Again, the loophole just was created because of the 2009 financial crisis, which at least Congress wanted to encourage people to do Roth conversions. So they allowed 2 years to pay the tax and opened up conversions to anyone to generate more revenue. Now they're actually going to take revenue out of their pocket because less people will do conversions. And in this case, no backdoor Roth IRAs are after tax to Roth. So there's no tax revenue lost. And trust me, rich people don't care about backdoor Roth IRAs. It's $6,000 or $7,000. They couldn't care less. Also, they want to eliminate Roth conversions if you make more than $450,000. Married, file jointly, $400,000 if you're single. So you're not going to be able to do Roth conversions. I've talked about this. They're, again, taking money out of their pocket because generally, if you make more than $450,000, you're in a higher tax bracket. You're going to pay more tax on your conversions. They also want to eliminate the mega backdoor Roth 401k, which allows generally self-employed individuals. Some 401k plans offer it, but not many, and basically allows you to do $58,000, $64,500 if you're over 50, 2021, go after tax to Roth. Not going to raise any revenue because it's after tax to Roth. It will actually decrease revenue because now people will be forced to do taxable deduction contributions pre-tax, which will reduce taxable revenue. So again, Warren Buffett, Jeff Bezos, Elon Musk, they couldn't care less about backdoor Roth 401ks. This is done by small business owners who are self-employed. And again, just cutting people's retirement accounts. It's really unfortunate. I'm not sure why the focus on hurting small business owners' ability to save. Look, we saw Social Security was raised 6%. It's going to go up 6% next year. Biggest increase in 40 years, right? There's no guarantee Social Security will be there in 20 or 30 years. Why? Because look, we know government changes rules on you. Look what they're doing to the Roth IRA. Look what they're doing to the cap. They are changing the rules on us. Who's to say in 20, 30 years, they don't say, you know what? Forget Social Security. You don't need it. Or if you make over 200,000 bucks, you don't get Social Security. Or if you're in this category, you don't get Social Security. They can change the rules on us. We've seen it. And it's not good policy because people lose faith in government and they lose faith in government programs, including the retirement system, which has always worked very, very well and it's always been bipartisan. And it's very disconcerting that the Democrats, again, I don't want to pile my frustration on the Democrats, but the facts are this should have been left out of the reconciliation bill. If they want to target retirement accounts, then let's talk about it, right? There should be there should be a process, public comments, so we all can talk about it and share our views with the members of Congress, and then the IRS could take those comments and restructure or redraft these provisions. But it's, I think, a mistake to just pile it into a 132,000 provision bill. Okay, they snuck it in there. There's 132,000 provisions. So I've been speaking to many members of Congress and senators, and the first thing they tell me is, Adam, I have no idea what the hell you're talking about. IRAs are in this bill. I have no idea. I said, well, you're on the Ways and Means Committee, sir. And they're like, yeah, there's 132,000 provisions in this bill. Like, what are you talking about? I don't know what you're talking about. So it's taken a month or so to get members of Congress to just wake up and say, oh my God, like, what is going on? Why are IRAs being attacked? I didn't really think about the potential impact this could have on small businesses raising money. And this leads me to this provision, which 138312, which is one of the worst provisions in this bill. And yes, I'm certainly not objective as someone who believes strongly in the self-directed IRA industry and the ability to diversify, but this is a bad provision. This does not help anyone. This provision says that if you have to provide some type of income, asset threshold, or minimum level of education or a specific license or credential to make an investment, i.e. you have to be accredited, can't do it. So that could potentially stop IRAs. It does not apply to 401ks and pension funds, only IRAs, from doing private placements like Reg A's, Reg D's, also private equity, hedge funds, angel investments, venture capital. All those investments generally require someone to be accredited. And again, this is a dramatic turn of events. The SEC over the last 7-8 years, since the Jobs Act, has been pushing, expanding the ability for more Americans to invest in small businesses through crowdfunding and expanding the rules for Reg A's, Reg D's, expanding the rules for accredited investors. And now what's happening is this provision wants to close it. Goes back to Peter Thiel, right? One person dictating policy. They believe that this provision will stop the next Peter Thiel from investing in startups or businesses. But again, they have their cap. If they're able to keep their cap, there'll never be another Peter Thiel because the cap's at 10 million. So this provision is pretty much irrelevant and has no value. And with $12 trillion in IRAs, all that money will no longer be available to invest in the next great American business. And with competition from China and the rest of the world increasing, we need to be able to support and fund our next great American businesses. And IRAs and retirement accounts are an important source of capital formation. And by taking $12 trillion off the table, that will be a wholly negative turn of events that could have an impact on our economy, ability for small businesses to raise capital, as well as the ability of small businesses to hire people. So again, there's been a lot more chatter on this, thankfully. I think more and more members of Congress and senators are fully understanding the scope and potential impact of this provision. Also starting to understand the broad impact it could have negatively, which I don't think was fully understood when the provision was drafted. So this will only raise 1.7 billion over 10 years, which I think doesn't make sense, because if you're telling people they can't make alternative asset investments, they're just going to buy stocks or do real estate. So I'm not sure how it's going to raise revenue. Now, one other important part of this provision is it says, and I think this will be removed. I have good, I don't want to say instincts, but I have some sources that say this is currently being removed, that if you have done in the past one of these investments, credit investor investments, for example, you have 2 years to remove it out of your IRA or it becomes taxable. So the issue with that is that that's going to raise tax, that's going to create taxable income for people under 450, which goes against everything the Biden and the Democrats are saying. So more likely than not, that 2-year threshold will be removed, but we're still confident that this provision will ultimately be removed. So that brings me to 138314, which is the second, I think, worst provision in this bill. And it basically says that if you invest in any business that you own more than 10% of in a private setting, or you're an officer of a business, private or public, your IRA can invest. Current rules are 50%. They're reducing that to 10% for private companies. And if you're an officer or a private or public company, you can't do it. And on top of that, if you've done an investment like this over the last 2 years, you have to unwind it or it becomes taxable. So again, I think that 2-year requirement will go away. I also do believe that this provision will not make it into a final bill because of the impact this can have on small businesses' ability to raise money through the IRA system. And again, they have the perimeter transaction rules already at 50%. And they can still attack transactions based off the self-dealing conflict of interest rules. So I'm not sure they need a 10% threshold. Some people say this could hurt checkbook control because you can't be an officer of an entity your IRA owns. Yeah, there'll be workarounds, like you can have a spouse or a third party as the manager. So there will be workarounds around that. But the checkbook control is not something they're attacking. This, again, goes back to Mr. Peter Thiel. They believe that if this provision was in the law when Peter Thiel was making his PayPal investments, probably not Facebook, but his PayPal investments, since he owned more than 10%, he would not have been able to make the PayPal investment. And then the 138312 would have stopped the Facebook investment because it would have required an accredited investor requirement. So again, this is attacking Peter Thiel. They believe there's lots of Peter Thiels out there, even though the facts are there's not. There's less than 500 Americans with more than 25 million, less than 30,000 Americans with more than 5 million. So not a major problem. The revenue raise on this, just 42 million over 10 years. So it's not clearly in there to raise revenue. This is a policy provision to attack Peter Thiel. So if you are upset, like I am, about these provisions, there's something you can do. Reach out to your member of Congress, especially if they're a Democrat. If you are living in a jurisdiction that has a member of the Ways and Means Committee, such as Neil of Massachusetts, Doggett of Texas, Kind of Wisconsin, Swayze of Long Island, Panetta of California, then Schneider of Illinois, reach out. It makes a difference. I've had hundreds of clients reach out to the members of Congress, gotten great feedback. If you want talking points, let me know. I'll send them to you. You can hit me up at info@IRA Financial, or you can hit us up on Facebook, Instagram, Twitter, YouTube, and I'll send you talking points. I'll send you a simple letter. Reach out to your members of Congress, reach out to your senators. Even if they're Republican, it's okay. Republicans still have friends on the other side. They talk, and it's important that they hear your views as a constituent and will better understand the negative impact these provisions could have. Also, they want to increase the statute of limitation for IRAs from 3 to 6 years. Even though it's not going to have a major impact, they expect it to raise just 8 million over 10 years. And again, this is my point, is that if they think there's so much abuse in the IRA world, then why you would think that increasing the statute of limitation 100% from 3 to 6 years will generate a lot more money than $8 million over 10 years. but that's the revenue number they have. So that tells me that it's probably not a big audit issue, right? It's just something that is being done to stop Peter Thiel and a certain type of taxpayer that they think is rich and abusing the situation. So they also want to give the IRS another $80 billion to go after you and me. Trust me, the rich people, they can afford lawyers to deal with the IRS. You and me can't. So that 80 billion bucks is going to go after small businesses, individuals, probably that make less than 450, or even if you make more than 450. The big guys that are making 5-10 million a year, they can afford the best lawyers and accountants to fight the IRS. We can't, right? We make a couple $100,000 a year, hopefully more in some good years, but we don't have the ability to hire top law firms to fight the IRS. We basically have to fold. So 80 billion is going to essentially double their budget, and we're going to be in the crossfire. So that's where we are. Again, I think the next couple of weeks will be important. Towards the end of the month, we'll learn more. Something's happening. 100%. There will be a reconciliation bill, whether it's 1.5 trillion, 2 trillion. Manchin understands it, even though he's moderate. He knows it's political suicide if the Democrats can't get anything passed. So something's happening. The hope is that it's shrunk and it's shrinking and is reduced. And the IRA, various provisions, the 138312, 138314 do not make it into the bill. Don't think we're going to be able to have success on the cap. I hope some members of Congress, especially in the Ways and Means, look at the back door and the mega back door and say, hey, really necessary to remove this? I mean, it's helping small business owners, individuals to save more in the retirement system and after-tax money, not hurting our treasury. Is that a bad thing? Like, shouldn't we be okay with that? I don't know. I'm hopeful, but we'll see. So let me get to some questions. I'm not going to touch vaccines on this podcast, on this video live. I'm sorry. I'm just not going there. Everyone should do what they want, but it's not my call. I have a Bitcoin in my IRA funds, and Gemini would like to buy a charity. You can't, your IRA, if you're under 70 and a half, you can't have your IRA invest in a charity. You'll have to take a taxable distribution and then invest in the charity. What's the status of Peter Thiel's provision, the IRA balances to a max of 10 mil? Yeah, as I mentioned, Mark, that likely will be in there because no one wants to defend rich people. It's just not a good time to stick your neck out for a bunch of rich people. So that's not going to happen. Even Republicans don't feel really confident doing that. Don't seem any need to do that because it's just not a popular approach. So I do think that will make it in there. I'm just more focused on 138312, 138314, which I think will have a larger scope impact on our economy and small businesses. So and if you have over 10 million, there'll be an income threshold. So if you're able to keep your income under 450 and you're married, file jointly, you will not have to take a taxable distribution. But if you can't, which probably most won't be able to, then even if you have a Roth, if you're under 59 and a half, you'll pay tax, not a 10% penalty. If you're over 59 and a half, you'll just have to take the money out in Roth. If you have pre-tax funds, you'll have to take the money out subject to tax, even if you're under 59 and a half. Adam, I'd like to reach out to my congressman to ask him to oppose these changes. Do you have a template letter? Yeah, James, hit me up. You can email me at Bergman at IRA Financial. Bergman at IRA Financial. I'll send you a template letter. Please do. Anyone who's watching or listening, please do the same. It will help. Trust me. Will the SALT state and local deduction limit 10K ever be repealed? Mark, yeah, I think it will. Actually, and that shows that it's not just about tax revenue, right? The Democrats in California and New York, they want to keep their voters happy. So they're focused on SALT. I've had a bunch of people reach out to, I'm not going to mention names, but several New York and California congressmen, and they basically said, yeah, IRAs, that's not something that's on our radar. We're focused on SALT. So and again, who's going to benefit from SALT? Rich people, right? Rich people have more than $10,000 in state and local deductions. not poor people, not middle class. So that's my issue with this, right? Don't just say that we're going after the rich, because then you're turning around and trying to get the SALT limit increased over $10,000. It's disingenuous. It's BS. If you want to attack the rich, then just be honest and say, we're attacking the rich. Anyone that makes over this amount, we're attacking them at 90%, right? That's kind of what it was in the 60s, 70s. So just be honest. But don't play all these tricks like, yeah, we want to tax the rich, but the number's 450, which that's not rich. It's successful. It's not rich. But you know what? We'll give the rich the SALT, and we'll also give the carried interest. We won't eliminate the tax benefits. We'll just extend the statute of limitations from 3 to 5 years. So Mr. Hedge Fund, Mr. Private Equity guy who supports the Democratic candidates won't be totally upset. So it's just political gatemanship, Game of Thrones stuff, Succession stuff. Everyone's fighting for a bite of the apple, and we'll see who wins. But it's not just about punishing rich people, because clearly the SALT deduction will help the rich people. Yeah, this is a nightmare. Yeah, it is a nightmare. And again, I'm going to be honest here. I'm a reasonable person. You want to increase capital gains tax a little bit to pay for some of these COVID programs. I think some of these programs are okay. You want to increase child tax credits. You want to give more families the ability to have paid leave, or help with rearing children at early ages. I can live with that. I'm fair. I'm reasonable. You want to increase taxes a couple percent, fine. If you make more than $5 million, you want to increase a 3% tax. I can live with some of this stuff. The IRA stuff is BS because it doesn't raise revenue. It's punishing Peter Thiel and punishing millions of other Americans as well. And it's going to hurt American businesses and hurt the ability of investors to diversify. So clearly, yeah, I'm not objective, but I would hope that even if I wasn't in the self-directed industry, I would think this is BS and really doesn't serve anyone's purpose except trying to show that they're punishing Peter Thiel. So I think some of these provisions are okay. It's not all a nightmare. We do have to pay for some of these programs. We have pumped $4 trillion into our economy in the last couple of years. So we got to pay for it. It's no one's fault, COVID, but some of the retirement provisions just are policy, and I don't think they should be part of this bill. Okay, Roth IRAs over 50.5 rules for 10 million. Yeah, you're going to have to pull the money out. If you're over 59.5, the Roth's been open 5 years and you got over 10 million, it's not the end of the world. You just got to pull the money out. Not taxable, but pull it out. Could be worse. It sucks if you're under 59.5 and have a Roth. That sucks. Because if you're under 59.5 and you have a taxable IRA, fine, you pull it out, but it is taxable, not subject to a 10% penalty. You would have had to pay tax anyways. You're just forced to take it out earlier than you wanted. Bad, but maybe not unconstitutional. The Roth, which the whole basis and foundation of the Roth is that these are tax-exempt accounts that you're not required to take out even once you're over 72 because there's no RMDs. Now, we're going to force you to take it out early and pay tax. Totally unfair, unreasonable, unconscious, I think unconstitutional. But again, I'm not sure. I haven't seen anyone willing to stick their neck out, even Republicans, to say this is wrong. I saw one op-ed by a former senator in the USA Today, Baucus, on Montana on it, and he basically said, grandfather people in. It's not fair to go after old Roths, which I agree that would solve any constitutional issues. But it's unfair, and you know what? People are going to lose faith in the retirement system. That's my concern. Is people are going to say, I don't trust this. They can change the rules on us. I'm going to save in other ways. I'm going to buy cryptos and have more control. I'm going to buy real estate where they can't steal the house. I don't want them just taking money out of my retirement accounts. So it's troubling. The retirement system, as I mentioned, has always been bipartisan. It's always been a system that works because it's based off mathematics and deferral and the powers of compounded returns. And unfortunately now they're trying to play games with it. And I think it will have a extremely negative impact on Americans' appetite to save more in the retirement system. So If we make over 450, can we make charitable donations to put? Yeah, Mar, you're going to be able to, but you're going to be limited to generally 20% of your income. So there'll be limits on how much you can give to charity. There'll be other ways to get deductions, right? You can put money maybe in a cash balance plan. If you're self-employed, that can give you another couple $100,000 of deductions. Charity, other ways, you can get divorced and give your ex-wife the money, your IRA. The only way to split the IRA is divorce, right? You can't just give your IRA away to a kid or charity. So you get divorced, give your spouse half the IRA, and then stay friends. I don't know what else you can do, but that's really the only way that you can reduce your IRA, get it under the 10 million. But you got to hopefully trust that other spouse or love the now divorced spouse. But again, that's what's going on here, right? Like I always said, one of the things I learned in law school that always made sense is that good tax policy shouldn't change behavior, right? You should be opening a business to make money, not to save taxes, right? You should choose an entity, corporation, or LLC for limited liability protection, not to save taxes. So once tax policy basically is motivating your actions, it's not neutral tax policy and not good. And that's what's going on here. They're forcing people to get divorced to save money or forcing you to not save for retirement, to save taxes. It's ludicrous and bonkers. And I still can't believe we're going down this rabbit hole. I really can't. And Grace, I appreciate all your questions. I know you're super frustrated like I am. Reach out to your members of Congress. Call them every day. Why not? Go for it. Let them know you have a voice. You should be heard. More and more people like Grace, do it. You'll make a difference. I promise. We're starting to get more traction. We're starting to get listened more. Congressmen and women are starting to understand our positions, our views, and say, hey, we're not here protecting the rich, right? We'll agree to your cap. Even though we don't agree with it, we'll concede it. But you're hurting everyday Americans here. People that just want to diversify, that maybe want to do a private placement or invest in a private equity fund or invest in a neighbor's business, invest in their community. You are stopping them from doing this, and it's wrong. And I think more and more people are understanding that IRAs serve a very, very important source of funding for local businesses. And 138312 and 138314 will stop that. So that's kind of the update number one. I'll probably do an update number two in 2 or 3 weeks when we learn more, unless if something breaks, like breaking news, I'll jump on. So that's why subscribe to this channel. So you'll get notified when I do a live session, and obviously it's free. So subscribe. There's nothing to lose. If you get sick of me, just don't go on and listen or watch. But I'll totally do a kind of spontaneous live if something breaks. But I do think we have probably more than weeks to figure out what's going on. So we don't have months. We have weeks. So every phone call matters. Every letter to your rep in Congress, your senator matters. They will listen. It's not stressful. It's not scary. I remember the first call I did, it was a couple of years ago when I was doing some lobbying. And I was like totally stressed out, a member of Congress, about an issue I was interested in. And turns out, first of all, you probably aren't going to speak to the member of Congress. You're going to get someone in their staff, and they listen. They actually care about you, especially if you're a constituent. They will listen. They will take your name down, your number down, and they will listen. And you may even ultimately get to speak to the member of Congress or to your senator, but they take the stuff seriously, especially if you're in their constituent. They will listen, and they will take your voice and your question and your issue seriously. So do it. And if you need a list of members of the Ways and Means Committee, you can ask me or you can Google it. It's on the Ways and Means Committee website. If you need talking points, let me know. I will send them to you. If you want a sample letter, let me know. I'll send it to you so you can shoot them an email. But I find calling helps, and they'll answer the phone. But calling, they make note of it. They take a record of the call, and the congressman or woman will get that message. So do it. Otherwise, we know the bill will be toned down. It will probably be around 2 trillion. Biden already understands. I think Pelosi's telling him that, hey, we need to get a deal done. And I think the progressives now need to be sold on the fact that they're not going to get everything they want. It's just the way it is. It's the way Washington works. Things need to be done slowly. That's generally the way good policy happens. You can't just turn 180 in 6 months. And I don't think actually Biden has that. I don't think he was voted in to do any type of sweeping policy. I think he was voted in to get rid of Trump, for whether you agree or not. But I think that is what his mandate was. I don't think his mandate was to create, basically Sweden or Finland, which is what he's trying to do, which is surprising because I actually respected. I think he's a good man, Biden. But I'm pretty surprised how he's tried to appease these progressives who I don't believe run the Democratic Party. I've talked to many Democratic members of Congress, and they said, Adam, yeah, they get all the social media attention. They're not running our party. We're still a moderate party. We still want to negotiate. We still want to talk and work with Republicans. And don't listen to all that noise over there. They're not that powerful. But it turns out they actually may be. So we shall see. Other than that, keep the good fight going. If you have questions, let me know. I do a Ask Adam every Thursday. So if you have self-directed retirement questions, hit me up. You can hit us up on, as I mentioned, YouTube, IRA Financial channel. We generally drop about 5 videos a week, 3 podcasts on various self-directed retirement, investment, tax topics. So it's free. It's great stuff. Subscribe. I put a lot of effort and work into it, so I hope you guys like it. If you have comments or questions, send them my way. It's all good. Also, follow us on Instagram, Facebook, Twitter, and love hearing from everyone in the self-directed retirement nation. It's been great to see everyone come together. The whole industry is united in terms of educating members of Congress and Senate on 138312, the accredited investor provision, and 138314, that 10% officer provision, which we need to get out of this bill because of its huge negative potential impact on all our abilities to diversify. I, like you, I am a self-directed investor. I've loaded up on real estate in the last few years and cryptos, and I feel good about it. I just dropped a podcast today called Adam Talks, which is a weekly podcast. I'm like up to episode maybe 200 and I don't know, 210, 215, doing them for a bunch of years. This one was all on inflation, that it's here. It's not just coming, it's here. Social Security is up almost is going to go up 6% next year. Almost 50% of small businesses were polled are going to raise prices next year. You fill up your car lately? I mean, it's a fortune to fill up your car. Grocery prices are up. I just got an email from a small restaurant in Sioux Falls, South Dakota, where our trust company is based out of, that I go. It's a great little restaurant, local restaurant. And they sent an email out saying, sorry, we're not going to be able to serve lunch anymore because we can't afford the cost of the groceries and we can't find people to work. Scary stuff. COVID sucks, but what's going to happen after COVID is going to be worse. You can't find any people. Prices are going up. There's no inflation's here. Okay. The government's admitting to it by increasing Social Security by 6%. The Fed's, for some reason, not willing to increase interest rates. And my concern is going to enter this spiral of inflation after COVID. And not to say that we can't be successful in a high interest rate environment. The 1980s had interest rates close to 20%, and it was a booming time. But we're going to need to get it under control and figure it out. So check out Adam Talks as well. It's a fun podcast every week, generally 15, 25 minutes. You can listen if you're in the car or jogging or just walking your dog, whatever. It's a lot of fun. So that's it. Appreciate everyone watching. You guys are awesome. And see everyone again next week. Be well, take care, and have a great week.